Welcome to the Deep Dive. Today we're digging into Lowe's Q2 2025 earnings. We'll look beyond the headlines, unpack the numbers, the big strategic plays, and what it all signals for the future. Okay, let's unpack this. So, starting right with those Q2 results, what were the top-line numbers?
Yeah, so total sales came in at $24 billion, and comparable sales, they saw growth of 1.1% for the quarter.
And that 1.1% wasn't just one area, right? It was both professional customers and DIY.
Exactly. They highlighted strength in both segments, pro and DIY. It really suggests, a broad-based momentum. Their strategies seem to be working across different customer types.
Okay, and what about the bottom line, the earnings per share?
Right, so adjusted diluted EPS hit $4.33. That's actually a nice jump, 5.6% year over year. Even the GAAP number, $4.27, was strong. That does include $43 million in transaction costs.
Related to that Artisan Design Group acquisition, ADG.
Precisely. So even factoring that in, the core profitability looks, pretty solid.
And I saw the gross margin ticked up as well to 33.8%, up 37 basis points. What drove that improvement?
Good catch. Yeah, that's a healthy sign. Management pointed to a few things. First, lower shrink, that's inventory loss. They also saw higher credit revenue and, continued benefits from their ongoing efficiency efforts, the PPI initiatives.
Perpetual Productivity Improvement, right?
Yeah.
Streamlining things.
Exactly. Just tightening up operations. It seems to be paying dividends, literally and figuratively.
Okay. Any other key metrics from the quarter? Transactions, inventory?
Yeah, a couple interesting points. The average ticket size actually increased 2.9%, but comparable transactions were down slightly, 1.8%. So fewer transactions, but bigger baskets, essentially.
Okay. And inventory?
They managed it down, ended the quarter at $16.3 billion, which is almost $500 million lower than last year. Seems like proactive management, keeping stock levels right without holding too much excess. And free cash flow was strong, too, $3.7 billion generated.
Now, something that really stood out to me was the monthly sales trend. It seemed to, accelerate quite a bit through the quarter.
It did. That was definitely notable.
Down 1% in May, then basically flat, up 0.3% in June, but then July popped 4.7%. That's a big swing.
A very big swing.
So the obvious question is, was that the start of a broader market turnaround or something specific to Lowe's?
Right. And management was very clear about this on the call. They said, yes, July was encouraging, partly helped by seasonal timing, better weather maybe. But, and this is the key part, they stated it was too early to call that a trend for the overall market.
Okay. So they're not jumping the gun on predicting a market recovery.
Not at all. Their forecast for the full year still assumes a roughly flat home improvement market. What they're basically saying is our growth, including that July number, is coming from our initiatives, our execution, not just a rising tide.
Got it. So it's more about them taking share through their strategies. What specific areas were strong then?
They had positive comps in 9 out of their 14 product categories. Pretty broad strength. Think hardware, lawn and garden, tools, building materials. Also rough plumbing, lumber, paint, flooring, appliances, a lot of core areas.
And pro sales continued to do well.
Yep. Building on gains from last year, and online sales were up 7.5%.
What's driving that online growth?
They pointed to improvements in the customer experience on the website and app, plus more people signing up for and using their MyLowe's rewards program. Builds loyalty, They also mentioned some newer marketing pushes, collaborations with folks like Mr. Beast, partnerships with Lionel Messi, the NFL. Seems like a clear effort to reach younger customers, Gen Z and millennials.
Interesting. Okay, let's switch gears to the really big news. The acquisition of Foundation Building Materials, FBM, an $8.8 billion deal. What exactly is FBM?
Right, huge news. FBM is a major distributor specializing in interior building products. So think drywall, steel studs, ceiling systems, insulation, commercial doors, those kinds of materials.
And the strategy behind buying them?
Lowe's called it transformational. It's all about boosting their total home strategy, specifically by expanding their offering for the large professional customer. They see this as unlocking a massive $250 billion addressable market focused on those large pros, and it directly builds on the ADG acquisition they just closed in June.
Okay, so ADG does interior finishes, flooring, cabinets, countertops. FBM does the sort of structural interior stuff like drywall. What's the vision for combining these?
The vision is pretty ambitious. They want to offer large pros a complete package, basically. Everything from drywall, ceiling systems, insulation, doors, flooring, cabinets, and countertops, all from one source Lowe's. Management was quite bold, saying there is no other player who can offer that comprehensive bundle to large pros right now. It's a direct challenge to competitors.
Beyond the product mix, FBM seems to bring other advantages too, like their geographic reach and customer base.
Absolutely. Geographically, FBM fills some key gaps for Lowe's, particularly in California, the Northeast, and the Midwest, where Lowe's might have fewer stores catering heavily to pros. Their customer base is also very diverse, 40,000 customers. No single one makes up more than 1% of revenue. That reduces risk.
And the mix is balanced between residential and commercial work.
Yeah, roughly 45% residential, 55% commercial, adds stability. And maybe most importantly, for a deal this size, FBM has integrated over 60 acquisitions themselves since 2011. They had a proven playbook for this stuff.
That experience must be invaluable. And what about technology? I heard they have some interesting tools.
They do. There's the MyFBM mobile app, real-time pricing, ordering, delivery tracking, even in Spanish. Very practical for pros on the go. But the really cool piece might be their AI blueprint takeoff tech. It basically reads digital construction plans and automatically figures out the materials needed, speeds up estimating significantly.
And Lowe's plans to roll that out more broadly.
That's the plan. Integrate capabilities like these into their own pro desk operations across their 1,750 plus stores, so extending those tech benefits beyond just the large FBM customers.
Okay, so integrating FBM, continuing with ADG, what does this mean for their outlook for the rest of 2025? What's the guidance now?
So they updated the full year forecast. Sales are now expected between $84.5 billion and $85.5 billion. Comparable sales guidance remains flat to up 1%. But crucially, this update mainly reflects adding ADG's numbers.
Right, FBM isn't baked in yet because the deal hasn't closed.
Exactly. FBM guidance will come later. Adjusted operating margin is projected at 12.2% to 12.3%, and adjusted EPS between $12.20 and $12.45. So stable outlook despite the flat market assumption.
Any specific guidance for the current quarter, Q3?
Yeah, for Q3, they expect comp sales to be about 125 basis points above the low end of that full year range. So slightly better momentum expected there. However, the adjusted operating margin rate is expected to be down about 20 basis points year over year in Q3.
Why the dip in margin for Q3?
Primarily due to the operating mix from ADG. Different business, different margin structure, just part of the integration process.
Now, a really big shift is the pause on share buybacks. They're stopping repurchases until debt levels come down, aiming for late 2027. What's the message there?
It's a clear signal of financial discipline. They spent big on FBM, and now they're prioritizing paying down that debt to get back to their target leverage ratio. That target is a debt-to-EBITDA ratio of 2.75 times. It shows they're serious about maintaining a healthy balance sheet.
So the capital allocation priorities are clear.
Crystal clear. First, invest in growth like these acquisitions. Second, the dividend aiming for that 35% payout. And then, once leverage is back in line, consider buybacks again. It means they're confident they can take market share with these moves, even if the overall market stays flat for a while. They're playing the long game.
What about the bigger picture, the macro environment? Did management offer any thoughts on that?
They did. They acknowledged some positives. Homeowners are generally in decent financial shape. The housing stock is older than ever, meaning more need for repairs and remodels. And they talked about significant pent-up demand for projects that have been delayed. They estimate that could be around $50 billion worth of work waiting to happen.
Sounds like a potential boom down the road.
Potentially. But they balance that with caution about the short term. High mortgage rates, that lock-in effect keeping people from moving, those are still headwinds. So they see the long-term potential, but they aren't banking on an immediate surge. They believe these acquisitions position them perfectly for whenever that recovery does happen.
With two big deals done or more on the horizon, and how do they manage integrating both ADG and FBM without, dropping the ball on the core retail business?
Good question. Management said explicitly, no more large acquisitions planned for now. Maybe some smaller tuck-ins here and there, but the focus is integration. And to manage that, they've set up separate, dedicated integration teams for ADG and for FBM.
So different teams working in parallel.
Exactly. The idea is to let those teams handle the integration complexities while the core Lowe's team stays focused on running the stores, the website, and their existing strategic initiatives like PPI.
Makes sense. Okay, so wrapping things up, solid Q2 performance, driven by their own strategies in a flat market, and then this massive, really game-changing bet on the pro customer with the FBM acquisition, adding to ADG.
That's the core story. If we connect this to the bigger picture, Lowe's is making a calculated and significant bet on the future shape of home improvement. They're investing heavily to dominate the large professional segment, positioning themselves to grab that pent-up demand when it's eventually released. So the real question for you listening is, how will this major strategic shift by Lowe's reshape the whole competitive landscape over the next few years? And what new opportunities or maybe challenges will that create for homeowners, DIYers, and the pros themselves?
A lot to think about there. Thank you for joining us for this deep dive.